I am 41 years old, and at the moment I'm writing this, I owe more money than I have earned in the last 5 years combined. Yet nothing in my life looks broken from the outside. I still go to work, still pay some bills on time, still answer emails politely. And people who know me casually would say I look tired, not ruined, which is the strangest part. Because the debt did not come from recklessness or desperation, but from a decision that once felt measured, adult, and almost boring in its logic. Before everything shifted, I was an engineer in supply and procurement, the kind of person companies trusted with numbers, timelines, and contracts, the kind of person who was praised for never improvising and never chasing miracles. I had spent nearly 2 decades moving goods instead of dreams, calculating margins, optimizing routes, negotiating delivery penalties down to the last decimal. Risk, to me, was not an emotion but a variable, and I had learned how to reduce it by procedure rather than hope. That is why when the warehouse project first appeared in my life, it did not feel like an opportunity so much as a natural extension of what I already understood. The site was a modest logistics complex on the edge of a mid-sized industrial city, nothing glamorous, just concrete, steel frames, loading docks, and access to a regional highway. No buzzwords, no innovation decks, no promises of exponential growth. Storage space rented to predictable tenants at predictable rates in a location that had not changed its zoning rules in 30 years. The numbers were clean. Acquisition cost plus renovation equaled a figure that fit neatly within conservative lending ratios. Rental projections were based on signed letters of intent, not forecasts. Even vacancy risk was modeled pessimistically, and still the return stayed solid, unspectacular but stable. During meetings, we did not talk about winning big, we talked about not losing. That alone made me listen. The partners were not strangers pulled from online introductions, but people I had crossed paths with professionally, men who had built their careers around infrastructure and compliance, not persuasion. Our conversations were dry in the best way: maintenance schedules, insurance coverage, tenant diversification, fire suppression upgrades. When I raised objections, they answered with documents, not reassurance. When I hesitated, they gave me time instead of pressure. I remember thinking that if this was what a mistake looked like, then the word mistake had lost its meaning. I ran the numbers myself, again and again, at night after work, adjusting assumptions downward just to see where the floor was. Even then, the floor held. The debt service coverage ratio remained comfortable. The loan terms were fixed, the interest rate modest, the repayment schedule long enough to absorb turbulence. This was not about becoming rich. It was about reallocating savings from stagnation into something tangible, something that existed whether markets were optimistic or afraid. I had watched too many colleagues chase volatile returns and end up frozen by fear. I wanted the opposite, an asset that rewarded patience, not timing. When I spoke about it with my wife, I framed it the way I framed procurement strategies at work: diversification away from pure cash exposure, inflation-resilient revenue, controlled downside. She trusted me because my career had been built on not over-promising and because I had never put us in a position where optimism replaced math. Even my internal dialogue lacked drama. There was no moment of excitement, no sense of stepping into a new identity. I did not imagine myself as an investor. I imagined myself as a custodian of concrete and leases. The phrase "ironclad" came up once in a meeting, half-jokingly, and we laughed at it, because nothing truly is. But the laughter itself felt like confirmation that we were adults who understood the limits of certainty. Looking back, that may have been the most dangerous comfort of all. The first serious decision arrived quietly, disguised as alignment rather than commitment. To secure better financing terms, the bank required a higher equity contribution up front, a gesture of confidence, they said, something that demonstrated long-term alignment. It made sense. More equity meant lower monthly pressure, more flexibility, a buffer against early vacancies. The spreadsheet favored it. The alternative was to keep part of my savings untouched and accept tighter covenants, less room to maneuver. I chose the option that reduced risk on paper. The day I authorized the transfer of nearly all my liquid savings into the project account, nothing dramatic happened. No alarm went off, no doubt surged. I remember sitting at my desk afterward, answering routine emails, feeling a mild satisfaction, the kind that comes from having closed a loop cleanly. Later that week, I signed the personal guarantee required to finalize the loan, reading every clause slowly, not because I was afraid, but because that was who I was. When I put the pen down, there was only a faint tightening in my chest, something I dismissed as respect for responsibility rather than fear. And I told myself, with complete sincerity, that this was what a rational decision felt like when it mattered. The first deviations arrived so quietly that I did not recognize them as deviations at all, just noise in an otherwise orderly system, the kind of friction every project absorbs before settling into rhythm. One tenant delayed move-in by 6 weeks because their internal compliance audit ran long. Another requested a short-term rent adjustment while they finalized staffing. Both explanations sounded reasonable because I had heard variations of them my entire career. Delays did not mean failure, they meant rescheduling cash flow, and cash flow could be smoothed. We revised the opening month projections, pushed revenue forward on the timeline, and the model still held. The bank did not object, the partners did not panic, I did not either. Then the city inspection added a requirement that had technically existed in the code for years, but had never been enforced at this scale: an upgraded fire suppression system for high-turnover pallet storage. The quote came in at just under $80,000. Unplanned but not catastrophic. We debated it, reviewed alternatives, appealed once, lost politely, and approved the expense. Infrastructure investments increased asset value, I reminded myself, and amortized costs mattered more than timing. I covered my portion with cash, telling myself it was better than increasing leverage. A month later, the electrical utility required a transformer upgrade to handle peak forklift charging loads, $42,000 total. Again, annoying but logical. We had underestimated peak draw, not usage, a technical oversight, not a structural flaw. My share came to a little over $14,000, and I wired it without hesitation. The spreadsheet bent but did not break. The issue was not the money itself, it was the rhythm of it. Each expense arrived framed as a one-time correction, each decision justified by preventing future inefficiencies. Temporary solutions, everyone said, and I agreed because temporary problems were the only kind I knew how to solve. When one tenant requested an early termination clause adjustment in exchange for a longer lease term, we accepted, trading certainty now for stability later. The monthly income dipped, but the average lease duration improved, which looked good on paper and even better to the bank. I told myself that professional investing was not about ideal conditions, but about adaptive management. The idea of exiting crossed my mind once, briefly, when I calculated how much equity I could recover if I sold my stake early. The number surprised me, not because it was low, but because it was lower than my contribution despite no obvious failure. Transaction costs, early exit penalties, loan origination fees that did not reverse. Losing money without having done anything wrong felt unfair, and that feeling itself became a reason to stay. I had not misjudged demand, I had not ignored risk, so why should I pay for impatience? When the partners proposed a short-term bridge to cover the revenue gap until occupancy stabilized, I agreed to inject more capital rather than dilute ownership or renegotiate debt. My additional contribution was $60,000, structured as a shareholder loan, senior to distributions. I told myself I was protecting my original investment, not doubling down. Around that time, I began noticing the disconnect between how the numbers behaved and how they felt. On paper, the project remained viable. In reality, my personal buffer was thinning. Savings that once represented security now existed only as historical entries on bank statements. I started tracking dates more closely, not milestones, but obligations, interest accrual dates, inspection deadlines. None of this alarmed me openly. I continued explaining the project to myself the way I would to an auditor, calmly, sequentially, as if clarity itself could substitute for comfort. Another tenant delayed payment due to a systems migration on their end, requesting a 30-day extension. We granted it, reluctantly, because enforcing penalties might have triggered vacancy. That decision cost me $12,000 in delayed distributions over 2 months. I made up the difference by drawing on a line of credit I had opened years earlier and never used, telling myself it was exactly what such tools were for: short-term liquidity mismatches, not losses. Still, something had shifted. I stopped recalculating the model for curiosity and started recalculating it for reassurance. Each revision required slightly more optimism than the last, not because assumptions were wrong, but because the margin for error was shrinking. When the bank requested updated financials and flagged the lower-than-expected initial performance, they did not threaten. They simply adjusted the reserve requirements, increasing the minimum cash balance we had to maintain. My share of that reserve was $25,000, locked away, untouchable. I transferred it with a sense of irritation rather than fear, annoyed at the inefficiency of idle money, yet unwilling to contest a request that was contractually sound. It was after that transfer, sitting alone with my laptop open to the account summary, that I understood something fundamental had changed. Even if I sold my stake tomorrow, even if a buyer appeared willing to assume the complexity, the proceeds would not cover my contributions, not after fees, not after settling the shareholder loan, not after unwinding guarantees. The math was clear, stripped of hope and narrative. Exiting would not restore what I had put in. It would only crystallize the loss. I closed the laptop and sat there longer than necessary, not upset, not angry, just aware. In the same way you become aware of a physical limitation after testing it one time too many, that from this point forward, every decision would be about minimizing damage, not avoiding it. By the time the pressure reached my personal life, it no longer arrived as events, but as conversations, calm voices delivering facts that were impossible to argue with because they were correct. The first was with the bank. A scheduled call that I joined from my car during lunch because it felt easier to keep moving while listening. They reviewed performance, acknowledged external factors, and then explained that the initial grace they had extended could not continue indefinitely. Payments would step up as outlined in the loan agreement, reserves notwithstanding. There was no accusation in their tone, no hint of hostility, only the gentle authority of a system functioning exactly as designed. I nodded even though they could not see me and thanked them for the clarity, hanging up with the strange sensation that politeness had replaced relief. At home, I began choosing words carefully, not to lie, but to compress. When my wife asked how the project was going, I said it was stabilizing, which was technically true if stabilization included prolonged strain. I stopped mentioning numbers unless asked directly, and even then I framed them as temporary imbalances rather than what they were becoming, fixed obligations with shrinking flexibility. The spreadsheet had turned into a schedule of endurance. Cash went out before it came in, and timing mattered more than totals. When one payment date approached faster than expected due to a recalculated interest period, I used the line of credit again, this time without the sense of appropriateness it once carried. It felt like borrowing time from myself, and the interest rate, variable and indifferent, felt personal in a way it never had before. The partners remained composed, which was perhaps the most unsettling part. In meetings, they spoke about optimization, not rescue, about alignment, not loss. One proposed adjusting the management fee structure to ensure operational continuity, a move that shifted more short-term burden onto individual stakeholders while preserving the project's long-term viability. The proposal was legally impeccable, unanimously approved, and quietly devastating to my monthly cash position. I agreed to it because disagreeing would have changed nothing except my standing, and standing, I told myself, still mattered. The word ironclad surfaced again in a meeting, this time in reference to the contracts protecting the asset from external claims, and I felt a brief, sharp flash of irony that passed without comment. Ironclad for whom, I wondered, and against what? At night, I began waking before my alarm, not from panic, but from calculation. My mind ran payment sequences the way it once ran logistics routes, testing permutations, shaving days, aligning inflows with outflows. I stopped thinking in months and started thinking in weeks. When the line of credit reached its limit, I applied for another, larger one, secured against future income rather than assets, the kind of product banks offer to people who look stable on paper and exhausted in person. The approval came quickly, which frightened me more than a rejection would have. With each new facility, my obligations layered themselves, one justifying the next, each one legal, reasonable, and documented. There was no villain to confront, no breach to litigate. Even the setbacks felt procedural. A tenant exercised a contractually permitted rent reduction tied to market benchmarks that had shifted downward, cutting monthly income by 8%. The clause had been there all along. I had read it. I had accepted it. Now it activated, quietly, efficiently. The numbers argued with my instincts daily. On paper, holding was still preferable to exiting. Liquidation would trigger immediate losses I could not absorb. Emotionally, holding felt like standing in place while the floor lowered around me. The phrase sunk cost floated through my mind more than once, but I rejected it each time, not out of ignorance, but because the alternative required acknowledging that discipline had turned into inertia. At home, silence expanded into spaces where conversations used to be. I avoided certain topics, not because they were forbidden, but because they demanded conclusions I did not yet have. I reassured my wife with progress reports that were accurate but incomplete, and I hated myself slightly for how natural that had become. The partners proposed one final restructuring. A defensive move, they said, to protect the asset through the next cycle. It involved extending the loan term, increasing the total interest paid, and, crucially, converting part of the shortfall into personally guaranteed obligations to satisfy lender requirements. The document was thick, its language precise, its logic unassailable. Without it, the project risked covenant breach. With it, the project survived, but I would carry the weight longer, deeper. I read every page slowly, the way I always had, noting the symmetry of clauses, the balance of responsibilities. This was not a trap, it was an offer shaped by necessity. When I signed, my hand did not shake. There was no dramatic pause, no sense of crossing a line. Only afterward, as I placed the pen down and slid the document across the table, did the realization settle with a dull certainty. This was no longer about returns, or even recovery. The language of investment no longer applied. From this point forward, every decision I made would be about staying afloat inside a structure that would not collapse, because it was never built to save me. Debt does not announce itself once it is settled in. It becomes ambient, like a low-frequency hum you stop noticing until the power cuts out and the silence feels unfamiliar. By then, it was no longer something I checked, but something I lived inside. Payments overlapped, Due dates clustered, and the language around them softened into administrative phrases: temporary delinquency, revised schedule, good faith adjustment. I learned which calls to return immediately and which could wait until morning without consequences compounding too quickly. Restructuring became routine, terms extended, rates recalculated, penalties waived in exchange for compliance. Each agreement arrived as a relief and left as a burden, lighter than default, heavier than before. Nothing exploded. No account went instantly dark. Instead, access narrowed, credit limits tightened, emails took longer to be answered. When I introduced myself on calls, I sensed a shift in tone once my name was entered into systems that remembered more than people did. Reputation did not vanish, it thinned. I was still reliable, still responsive, but no longer unquestioned. I began explaining myself preemptively, offering context where none was requested, a habit I noticed only after it had become automatic. The shame was not loud, it was practical. I avoided certain conversations because they required summaries I did not want to condense. I declined invitations not because I lacked time, but because small talk felt like a performance I could no longer afford. At work, I remained competent, but my confidence flattened. Decisions that once felt proportional now felt loaded, every commitment echoing beyond its scope. Future plans lost specificity, vacations became hypotheticals, purchases were delayed not out of discipline but out of fatigue. I stopped imagining outcomes and focused on sequences, what needed to be paid first, what could be deferred without triggering escalation. There was no anger toward the partners because they had acted within frameworks we all agreed to. No resentment toward the bank because they enforced what I had signed. I was not a victim of deception. The documents were clear, the risks disclosed. Each signature had been deliberate. That clarity made everything worse. There was no external narrative to borrow, no one to blame without lying to myself. When friends asked how things were going, I said, busy, which was true in the narrowest sense. My wife knew more than anyone else, but even with her I edited, not to mislead, but to avoid repetition of facts we could not change. Silence became efficient. Over time, the project receded from being something I managed to something that managed me. I reacted rather than planned. When a minor payment went overdue due to a misaligned transfer, the notification felt disproportionate to the amount, not because it was severe, but because it confirmed how little slack remained. I corrected it immediately, of course. I always did. Compliance was my last asset. The irony was that the structure itself remained intact. The warehouse operated. Tenants came and went within expected ranges. From the outside, it was functioning. From the inside, it was a machine calibrated to outlast the people feeding it. Late at night, after the house was quiet, I sat at the table with printed statements spread out in front of me, not because digital tools were insufficient, but because paper made the numbers feel finite. I added columns that did not reconcile, traced obligations back to origins I remembered clearly, moments where alternative choices had existed but felt irrational at the time. There was no single decision I could isolate as fatal. That was the hardest part. The erosion had been cumulative, reasonable, incremental. I stayed there until the arithmetic stopped changing no matter how many times I recalculated, until it was clear that there was no scenario left to discover, no hidden turn where things reversed. Just maintenance, just endurance. I gathered the papers, stacked them neatly, and turned off the light, aware with a steady, unremarkable certainty that the future I had once planned for had already been replaced by something narrower, quieter, and entirely of my own making. I no longer measure time by progress, only by continuity. The debts are still there, reshaped but not erased, stretched across years instead of months, their presence normalized into my daily routines. I pay what I owe according to schedules that leave little room for surprise, and in that predictability there is a kind of peace, not relief, just the absence of escalation. My life has narrowed in ways that are difficult to explain without sounding dramatic, so I usually don't try. We moved to a smaller place, not because we had to immediately, but because the larger one no longer made sense. Fewer rooms meant fewer decisions, fewer reminders of plans that had been drafted and quietly abandoned. I sold the car I liked and kept the one that worked. I stopped checking investment news entirely, not out of bitterness, but because it no longer applied to the way I lived. What remains is functional. Enough. Illusions did not collapse all at once, they simply failed to renew themselves. I no longer tell myself stories about recovery curves or long-term upside. I tell myself what is due on the 15th and what clears on the 28th. I am not unhappy in the way people expect. I am steadier than that, flatter. There is less anticipation, but also less disappointment. One afternoon, months after the worst had already passed, I drove out to the warehouse alone. There was no meeting scheduled, no issue to resolve. I parked at the far end of the lot and walked the perimeter slowly, listening to the sound of my steps echo against concrete. The building looked exactly as it should have. Clean lines, maintained docks, a structure doing precisely what it was designed to do. Trucks came and went, pallets moved, lights flickered on automatically as the sun dipped. Standing there, I felt no anger toward it. The warehouse had kept every promise it had made to itself. It had never promised to protect me. Inside, an office door stood open, a desk cleared except for a clipboard and a pen attached by a chain. I sat down and reviewed a routine operations report, signing my name where it was required. The motion familiar, almost comforting. My signature still looked the same. That struck me more than it should have. Later, at home, my wife asked how it went. I told her it was quiet. We stood in the kitchen without urgency, talking about groceries, about the weekend, about nothing that needed to be resolved immediately. The conversation felt honest because it did not pretend toward futures we were no longer building in the same way. That night, I opened an old folder on my computer, one I had not touched in a long time, labeled simply Projections. I scrolled through versions of spreadsheets, each one conservative, each one logical, each one convincing in its moment. I did not delete them. I closed the folder and left it where it was, a record rather than a warning. There was no final reckoning, no cathartic menace, just acceptance, gradual and complete. I understand now that the most dangerous projects are not the ones that advertise risk, but the ones that remove it from the language entirely, the ones that replace excitement with plausibility, uncertainty with process. I did not lose myself to recklessness. I lost myself to reason applied without humility. Every step had made sense in isolation. Every document had been readable. Every signature had been mine. That is the part that stays with me, not as regret, but as clarity. Trust is not a feeling, it is a series of permissions you grant, often to systems that do not know your name. Numbers do not deceive, they simply omit what they are not built to hold. When I think back to the word we once used jokingly, the one that implied permanence and safety, it no longer feels bitter, it feels instructive. Concrete does not bend, it holds or it does not. And when you build your life too close to it, You learn that survival is not about avoiding collapse, but about learning how to stand when nothing gives way.